What if I told you that there were people, businesses, organizations whose sole purpose was to loan you money? And all you had to do to get that money is fill out an application. Is that something that would interest you? Now, it might not be quite as easy as just filling out an application. However, it's not much harder than that because just like going to school and having an open book test, the same thing is kind of similar to when it comes to getting a home loan to purchase a home. So I'll come back to that in just a moment in terms of explaining what I mean. Let's take a step away from real estate for a minute, and I want to tell you a story about when I started investing in the stock market. It was 2020, shortly after the pandemic had started. We were all at home and had a lot more time on our hands. Most people were signing up for Netflix accounts and watching Netflix and finding other things to do with their time that, could occupy it or entertain them. I dove into learning about the stock market and learning about how it works and how I could invest in the stock market to take advantage of what I saw as an opportunity. So I quickly jumped in, started learning about the stock market, started throwing a little bit of money into the stock market. Over the next few months, that money grew. And then a few months later, that money kept growing. And so I threw more money into the stock market and it kept growing throughout the rest of the year in 2020. 2021 comes and I continue with the trend because I've been learning about the stock market. I'm picking all the right stocks and the market just keeps going up and my money is just growing and I'm feeling like a genius with my decision to start investing in the stock market, picking all the right stocks and just watching the amount of money I have just grow and grow and grow week after week after month and then throughout 2021 as well. New year turns into 2022, Federal Reserve hikes up the interest rates and the stock market feels that heavy and it starts to drop as a whole. And so I start to see my earnings that I had made over the last year and a half, year and 3/4 start to dwindle a little bit. And so I started wondering, okay, you know what? One of the things I heard is just stay invested, stay invested. It's going to turn back around. And so I see it start dwindling a little bit more and I hold on for another month or two and still dwindling. And I can't do it anymore. I sell all my stocks. Not all of them, actually. I sold a good portion of them. But I kept some that were invested, but I sold a good portion of them just to stop the bleeding because it's an emotional pull that the stock market will have on you. And after I sold them, I watched the stock market continue to go down further and further and further. And so I felt like I made a good decision. In hindsight, I realized that all of the money that I was able to grow in the stock market had absolutely nothing to do with how great I was at picking stocks. You could have in 2020 thrown a dart at a stock, particularly in the technology sector or in the software as a service sector, and watch that stock go up because so much money was just flooding into the stock market and stocks were just going up left and right. People were making a lot of money during that 2020 and 2021 because the valuations of companies were just exploding. And obviously a lot of that was inflated, companies being overvalued, but a lot of it being due to the pandemic and the circumstances we were in, where now is this work from home culture. And a lot of those software as a service, a lot of those Netflix exploded during that time. A lot of companies that were virtual companies, Zoom saw a huge growth during that time. Those companies really saw things take off. And so it was less to do with me and more to do with the environment that I was in and me just stepping in at a good time to start investing. And then when things started to turn, I didn't want to be a part of that turn. So I tried to hang on for a little bit, but wasn't able to ride it all the way to the bottom, which I'm not complaining about that. at all. At some point, I'm gonna jump back into the stock market. I haven't fully jumped back into investing yet. It is an emotional ride for me. I'm more of a big real estate investor than I am a throw all my money in the stock market and let it grow over the next couple decades. But that's still a great option, because in the long term, the stock market averages about, or at least the S&P 500, I'll say that, which is the benchmark for that a lot of people measure themselves in terms of how well they're doing in the stock market, averages on average about 10% year over year. Now, some of those years you're going to take a loss. Some of those years you're going to have some huge wins. So in order to actually realize that 10%, you're going to have to stay invested in the stock market over a long period of time. And so that's the thing, is that there are a lot of risk involved with the stock market. There's a lot of emotion involved with the stock market, but there can be some really good rewards that you also get from the stock market as well. The people who tend to do the best are the ones that take the time to actually learn the stock market. And I'm hesitant to use the word play or game for that matter, even though a lot of people like to see the stock market as like a game that they play. But they take the time to really learn the art of investing in the stock market, doing the research into the management teams behind the companies that they're investing in, so that they can really get a feel for who are these leaders, the CEOs, the CFOs, the COOs that are running these companies, and what's their philosophy, what are their thoughts for where they see this company growing from where they are now. There's a lot of those people that tend to do all of the research, tend to do a little bit better than people that just start going in and picking stocks left and right. There's another group of people that also tend to do pretty well, and those are people that pick a good fund that tracks the S&P 500, because most investors cannot beat the S&P 500. Believe it or not, the S&P 500 still is the benchmark for a reason, and most investors can't beat it. Most investors, their returns fall short of the S&P 500. So why am I telling you about all of this with stocks and everything? It all comes down to risk. When you're investing your money in anything, you are weighing the risk of losing that money versus the reward of what you could potentially gain from that investment. A lender's job is to essentially invest their money in people. They want to loan their money to you and to your family, to your friends, your whole circle of influence. They want to loan money, and for a lender, it's them investing their money in you. But they want to know that their investment has a high probability of a return, because if they invest their money in you, but then there's no return on that investment, that's not a business model that's going to allow a lender to stay in business for long. So there are guidelines and criteria that generally most lenders use, i.e. FHA guidelines, conventional guidelines that Fannie Mae and Freddie Mac have put into place to qualify individuals that are seen as being an acceptable risk to take in terms of loaning hundreds of thousands of dollars to, and then getting a return off of your investment. That, at the end of the day, is what it is for someone on the lending side. So when you're looking at going to purchase a home, try to view it from the eye of the investor or the lender. You are the investment. Whereas when you invest your money in the stock market, you would not invest your money in something that you felt was not going to give you a return. You wouldn't go throw your money in a company that you felt was going to be going under soon, or a company that did not have a good track record of being able to make money or operate, on the positive side of their balance sheet or whatever it is. In the same way, a lender is looking at you and everyone else who applies for a loan as an investment. And are you going to be a good investment that they can in turn, here's 400,000, here's 800,000, here's 1.5 million. I'm willing to give you that because I know that you're a good investment and you're going to make me that money back, or you're going to be able to make the monthly one-time payments as we agreed upon. And so when it comes to getting a loan for a home, and taking it back to the open book test reference that I used earlier, all the guidelines that you would need to follow in order to be approved for a loan are out there. It's not a secret. FHA, you know what the credit score minimums are, you know how the debt to income ratio is done. And if you don't know, you can talk to a loan officer, and a loan officer will give you all of that information. They will tell you what your debt to income ratio needs to be. They will tell you what your credit score needs to be. Now, if it comes to, depending upon how you get approved, whether it's an automated approval, that target might be a little bit more fluid depending upon all the different factors that play into your financial picture. But if you're doing a manual approval, i.e., let's just say you're playing it safe in terms of what you would be able to qualify for, all of those guidelines are pretty hard written in stone, i.e., this is what your debt to income ratio needs to be. This is the max that your debt to income ratio can be. This is the max that your loan to value ratio can be. These are the guidelines for you to qualify for a manual underwrite of an FHA loan or a manual underwrite of a conventional loan. And so with all of that information being out there, you can talk to a loan officer to know what it is you need to do so that you can qualify for all of this money that they want to give you. Because keep that in mind, a lender wants to loan you the money. They want to have a good investment. They want to make a good investment. Just like if there's a great investment out there for you to put your money in, you want to put your money there. Why would you not want to get a 10% rate of return or 15% or 20% rate of return on your money? If there's a great investment like that that's out there, you're going to put as much of your money into those great investments because you're going to get your money back. A lender wants to put their money in a great investment. So be that great investment. Find out what it is that you can do to start turning your credit score around and making yourself even more appealing in the eyes of a lender. Find out what it is that you can do to have your credit profile look a little bit more appealing, i.e. no late payments, credit card balances staying low, you're paying all your bills on time, so that you're looking more appealing in the eyes of a lender. You've got a job that you've held for the last 2 years. So you've got steady employment that you can show. Find out those things that make you look like a great investment and just do those things. And I guarantee you a lender is going to loan you money. There have been so many guidelines that have been changed in the recent few years even, to just try and make things a little bit easier for home buyers to be able to get into homes. There have been a lot more down payment assistance programs that have been put out there, and a lot more grant money that has been put out there as well, because there's benefit in having more Americans own the homes that they live in. Communities are better. More wealth is being able to be created, particularly generationally from family member to family member. And so there are a lot of benefits that I think society as a whole benefits from when more people own the land rather than having a few people own the land and everybody just renting from a few. And so with that, make yourself the great investment. Do the things that you need to do to start improving your credit, lowering your debt, improving your income, because those three things surround the overwhelming majority of how a lender is going to view you in terms of, are you going to be a risky investment that I don't want to take that risk on? Or are you going to be a great investment and I'm happy to take that risk because it's a low risk and a high probability of me getting a return on that investment? So that's what I have for you. Thank you for taking the time to tune in. Make sure you do like and subscribe to the podcast. I would greatly appreciate it. And stay tuned because I got some more great stuff coming up for you. I know that you've probably heard, if you've listened to the last couple of episodes, I am going to be changing up the platform. It is coming. Give it like another couple weeks, but it is coming. I've got some really, really great interviews lined up for you from some amazing agents, some amazing individuals who are just crushing it in what they're doing in real estate and being able to help people as well. And so I want to highlight a lot of that, of what's going on, particularly in my city in Atlanta as well. So stay tuned. Those interviews are coming. Those podcasts are coming. So just stick with me. Stay tuned. In the meantime, take care, be blessed, and we'll see you in the next episode.